Recording in progress.
Okay. So in the previous chapter, we saw about the market's perspective, where the author is telling about, how consistent traders make themselves available whenever the opportunities are presented. And that is what the author calls as the zone. And and the author also says about how to keep yourself uh, focused in the when the opportunity is presented. And and the author also says that uh, first thing is why you don't kind of um, learn, because it is very easy to start trading. And the second one is that you can trade anywhere, so you don't take time to learn the markets. And the market's behavior is actually uh, very random. So that is a market's perspective. So that is what we need to look into it. And what happens is either you will be, you can trade, but it will be undisciplined and unorganized and haphazard manner. And if you are arrogant, you will basically end up losing money. Okay. So the first mistake which we have to do is we are not defining our risk, and we are not cutting our losses, and we are not taking profits consistently. So these three are the things we don't. When we enter a trade, we don't tell this is how much I will lose and this is how much. And when the loss happens, we basically don't exit. Or if we get the profit, we wait, we become greedy, and uh, we don't take the profits. And so this is where if we keep failing. And the author also says that uh, because we don't do it because we don't believe it is necessary, right? And that is the issue, right? So so you have to assume that you don't know anything can happen, so always ensure cut your losses. And so we have to think our mind in terms of probabilities. So this is what we saw in the previous chapter about the market's perspective. And the final take is that you have to predefine your risk, you have to cut your losses, and you have to take profits whenever it is being provided. Don't be greedy. The trader's edge, thinking in probabilities. Now the previous chapter ended by telling that the trader has to think in terms of probabilities, and how to think in terms of probabilities is what is mentioned in this particular chapter. Exactly what does it mean to think in probabilities, and why is it so essential to one's consistent success as a trader? If you take a moment and analyze the last sentence, you will notice that I made a consistency a function of probabilities. It sounds like a contradiction. How can someone produce consistent results from an event that has an uncertain probabilistic outcome? To answer this question, all we have to do is look to the gambling industry. So, in this paragraph, the author is trying to tell you have to think in terms of probability, and that is needed for consistent success. But when you take the word probability, you have success as well as failure. So it sounds like a contradiction, right? How can you be consistent and also think in terms of probability, right? And because there is always an uncertainty. Okay, and to answer that, author is asking to look into the gambling industries. Corporations spend vast amounts of money in the hundreds of millions, if not billions of dollars on elaborate hotels to attract people to their casinos. If you have been to Las Vegas, you know exactly what I'm talking about. Gaming corporations are just like other corporations in that they have to justify how they allocate their assets to a board of directors and ultimately to their stockholders. How do you suppose they justify spending vast sums of money on elaborate hotels and casinos whose primary function is to generate revenue from an event that has a purely random outcome? So, for this, the author is asking us to look into the gambling industry, and casinos spend a lot of money, you know, by building a fantastic hotel and all these things. And in any gambling, obviously, it is like uh, it is going, that's a probability, so people might come or might not come, something like that. And how can you justify spending so much money in those probabilities? Paradox: random outcome, consistent results. Here is an interesting paradox. Casinos make consistent profits day after day and year after year, facilitating an event that has a purely random outcome. At the same time, most traders believe that the outcome of the market's behavior is not random, yet cannot seem to produce consistent profits. Shouldn't a consistent non-random outcome produce consistent results, and a random outcome produce random inconsistent results? So the author is trying to tell a paradox. Paradox is that, something which is contradicting itself. You have something, an outcome is always random, but if the outcome is random, how could the result be consistent, right? But the author is telling that casinos actually keep on generating consistent profits every day, every year, and every month by conducting events that is inside the casino, which has purely random. And but traders, we as traders, we believe that if the market's behavior is not random. Okay, but what happens is, but our results are not, profits are not consistent. We think that market is always uh, not random and it has some patterns, but when we trade, we don't produce consistent profits, right? So shouldn't a consistent non-random outcome produce consistent results, and a random outcome produce random inconsistent results? So the gaming industry is actually having, in the casinos, the events inside are random, but the results are consistent. But we think that, market behavior is not random, but it is actually giving inconsistent results. What casino owners, experienced gamblers, and the best traders understand that the typical trader finds difficult to grasp is events that have probable outcomes can produce consistent results. If you can get the odds in your favor, then there is a large enough sample size. The best traders treat trading like a numbers game, similar to the way in which casinos and professional gamblers approach gambling. Okay, so this is something that looks very profound, and events that have a probable outcome, they can produce consistent results if you can get the odds in your favor. So there is some probability, and if the probability is in your favor, then it is it is a large enough sample size, then you can make consistent result. To illustrate, let's look at the game of blackjack. In blackjack, the casinos have approximately a 4.5% edge over the player based on the rules they require players to adhere to. This means that over a large enough sample size, number of hands played, the casino will generate net profits of 4.5 cents on every dollar waged on the game. This average of 4.5 cents takes into account all the players who walked away big winners, including all winning streaks, all the players who walked away big losers, and everybody in between. At the end of the day, week, month, or year, the casino always ends up with approximately 4.5% of the total amount wagered. So, to explain this, now what the author is telling is that there is some event where the probability is in your favor, the odds are in your favor, and and if you take that particular opportunity, you will win. with a large number of sampling. So, so to illustrate this, the author is telling about the game called Blackjack. Okay, the casinos have approximately 4.5% edge over the player. Okay, so that is uh, for every dollar waged on the game, the casino will actually generate 4.5 cents, 4.5 cents. Okay, now this, in spite of some large number of players might have played, but still what happened, somebody huge would have won, somebody would have lost, somebody would have been in between. So after spending all the profits and loss, transferring all these things, the casino still makes 4.5%, 4.5 cents per dollar. Okay, at the end of the day, with approximately 4.5% of the total amount wagered. So that 4.5% might not sound like a lot, but let us put it in perspective. Suppose a total of $100 million is wagered collectively at all of a casino's blackjack tables over the course of a year. The casino will net $4.5 million. So in a year, the casino will make almost $4.5 million if a collective wager of $100 million is done. What casino owners and professional gamblers understand about the nature of probabilities is that each individual hand played is statistically independent of every other hand. This means that each individual hand is a unique event where the outcome is random relative to the last hand played or the next hand played. If you focus on each hand individually, there will be a random, unpredictable distribution between winning and losing hands. But on a collective basis, just the opposite is true. If a large enough number of hands is played, patterns will emerge that produce a consistent, predictable, and statistically reliable outcome. So, probability, actually what happens is that, every time each of the player has an statistically each of the player has an independent probability, n number of infinite probability. Okay, but each hand, whenever each player who is playing, irrespective of the previous player won or lost, he has a probability of winning or losing. That is what he's telling. So if you focus individually, okay, there will be a random, unpredictable distribution. Okay, which means that sometimes the previous one might win, previous mode might lose, something like that. Previous player might have, consequently 3 players would have consequently won, and then the probability of this player winning also might not be the same. But if a large number of hands are played, comes just if you take the sampling size, sampling of that entire thing, then there will be a pattern. Okay, so if a large number of hands are played, patterns will emerge that produce a consistent, predictable, and statistically reliable outcome. So this is like our chart patterns. Here is what makes thinking in probability so difficult. It requires 2 layers of belief that on the surface seem to contradict each other. We'll call the first layer the micro level. At this level, you have to believe in this uncertainty and unpredictability of the outcome of each individual hand. You know the truth of this uncertainty because there are always a number of unknown variables affecting the consistency of the deck that each new hand is drawn from. For example, you cannot know in advance how any of the other participants will decide to play their hands, since they can either take or decline additional cards. Any variables acting on the consistency of the deck that cannot be controlled or known in advance will make the outcome of any particular hand both uncertain and random in relationship to any other hand. So this is looking a little bit difficult. We'll go through again. This entire chapter is about how to think in terms of probabilities, right? So basically you have to think, there are 2 beliefs, okay, which is contradicting to each other. Okay, 2 beliefs on the surface which seem to contradict with each other. Okay, so the first belief is the micro level. Okay, what is the micro level belief? At this level, you have to believe that in the uncertainty and unpredictability of the outcome of each individual. Just like I said, each player will have infinite probability. So that is if you go player by player, that is a micro level, there is an uncertainty and unpredictability. Okay, this is the first belief. Sorry. You know the truth of this uncertainty because there are always a number of unknown variables affecting the consistency of the deck that each new hand is drawn from. Okay, so we know that this is uncertain because each player is not consistent. Okay, and for example, you cannot know in advance how any of the other participants will decide to play their hands, right? So since they can take or decline additional cards. Yeah, because each player can take one or more of the cards, right? Any variables acting on the consistency of the deck cannot be controlled or known in advance, will make the outcome of any particular hand both certain and random. Since we cannot know what each player is going to do, the outcome of that also will be random. So this is the micro level. That is what the author is telling. Okay. The second layer is the macro level. So, okay. So as he said here, individually, it is very infinite possibilities are there, but when you collectively see, there is a pattern. That is what the author is trying to tell. That is what the probability is. So the second layer is the macro level. At this level, you have to believe that the outcome over a series of hands played is relatively certain and predictable. The degree of certainty is based on the fixed or constant variables that are known in advance and specifically designed to give an advantage to one side or the other. The constant variables I'm referring to are the rules of the game. So even though you don't or could not know in advance, unless you are a psychic, the sequence of wins to losses, you can be relatively certain that if enough hands are played, whoever has the hedge will end up with more wins than losses. The degree of certainty is a function of how good the edge is. Okay. So the second layer is actually the macro level. Basically, a series of players, if they are consistently winning, then there is a probability. That is what? That is the edge. So that is what the author calls as the edge. Okay. So, and you can be relatively certain that if enough hands are played, whoever has the edge will end up with more wins than losses. So this is the edge. So this is the trader's edge. And the degree of certainty is a function of how good the edge is. Okay. It is the ability to believe in the unpredictability of the game at the micro level and simultaneously believe in the predictability of the game at the macro level that makes the casino and the professional gambler effective and successful at what they do. Their belief in the uniqueness of each hand prevents them from engaging in the pointless endeavor of trying to predict the outcome of each individual hand. Okay. So they believe in their system, they believe in the unpredictability of the game at the micro level, as at the same time, they believe in the predictability of the game at the macro level. And because of their belief, they actually try to they don't end up in looking at each player whether they are winning or losing. They have learned and completely accepted the fact that they don't know what is going to happen next. More important, they don't need to know in order to make money consistently. Because they don't have to know what is going to happen next, they don't place any special significance, emotional or otherwise, on each individual hand, spin of the wheel, or roll of the dice. In other words, they are not encumbered by unrealistic expectations about what is going to happen, nor are their egos involved in a way that makes them have to be right. As a result, it is easier to stay focused on keeping the odds in their favor and executing flawlessly, which in turn makes them less susceptible to making costly mistakes. They stay relaxed because they are committed and willing to let the probabilities play themselves out, all the while knowing that if their edges are good enough and the sample sizes are big enough, they will come out net winners. So, the consistent traders, consistent winners, what they believe in the probability. They don't go emotionally, they don't go take any trade, based on their emotions. They They don't have unrealistic expectations also, and they are going to stay relaxed because they are committed and willing to let the probabilities play themselves out. Okay, and they also know that if their edges are good enough and the sample size are big enough, they will come out as winners. Okay, so the best traders use the same thinking strategy as the casino and professional gambler. Not only does it work to their benefit, but the underlying dynamics supporting the need for such a strategy are exactly the same in trading as they are in gambling. A simple comparison between the two will demonstrate this quite clearly. Okay. First, the trader, the gambler, and the casino are all dealing with both known and unknown variables that affect the outcome of each trade or gambling event. In gambling, the known variables are the rules of the game. In trading, the known variables are the results of their market analysis. Market analysis finds behavior patterns in the collective actions of everyone participating in the market. We know that individuals will act the same way under similar situations and circumstances over and over again, producing observable patterns of behavior. By the same token, groups of individuals interacting with one another day after day, week after week also produce behavior patterns that repeat themselves. So the author is telling in the gambling there is actually both are dealing with, as well as trading, both are dealing with uncertain unknown variables, and then there are also some known variables. So in gambling the rules of the game are the known variables. Okay, and what is the in trading, the basically the market analysis is the known variable in case of trading. Okay, and then we have the behavior patterns, we have the how each and every market is behaving, and individuals will act the same way under similar situations and circumstances over and over again, producing observable patterns of behavior, right? So by the same token, groups of individuals interacting with one another day after day, week after week also produce behavior patterns that repeat themselves. These collective behavior patterns can be discovered and subsequently identified by using analytical tools such as trend lines, moving averages, oscillators, or retracements, just to name a few of the thousands that are available to any trader. Each analytical tool uses a set of criteria to define the boundaries of each behavior pattern identified. The set of criteria and the boundaries identified are the trader's known market variables. They are to the individual trader what the rules of the game are to the casino and gambler. By this, I mean the trader's analytical tools are the known variables that put the odds of success for any given trade in the trader's favor. In the same way that the rules of the game put the odds of success in favor of the casino. So basically, we have this behavior pattern, whatever we are telling, that is actually called the trend lines. We have the moving averages, we have the oscillators or retracements, and these are all the tools which we use, and we have certain criteria where we define the boundary and behavior pattern is also identified, and the set of criteria and the boundaries identified are the traders known market variables. So just like these trend lines, these moving averages, these patterns which we see, trade chart patterns, these are all the market variables for the trader. And just like how for the casino player and the gambler the rules of the games are the variables, for this, for a trader, the trend lines, moving averages are all the market variables, right? And so this, I mean, the trader's analytical tools are the known variables, okay, that will make the trader successful. The second one, we know that in gambling a number of unknown variables act on the outcome of each game. In blackjack, the unknowns are the shuffling of the deck and how the players choose to play their hands. In craps, it is how the dice are thrown, and in roulette, it is the amount of force applied to spin the wheel. All these unknown variables act as forces on the outcome of each individual event in a way that causes each event to be statistically independent of any other individual event, thereby creating a random distribution between wins and losses. Okay, so the rules are one thing in gambling, and similar to rules, we have the market variables like trend lines and all these things. However, there is a second thing. Basically, in how much you shuffle the deck in blackjack and how you choose to play their hands. That is an unknown variable, right? You can shuffle any number of times. And in craps, what they're telling, how you throw the dice, dice can land whatever number you want. That is an unknown variable. And in roulette, basically when it rolls, you have to put some force to spin the wheel. And how much force you put and where it ends up, that is an unknown variable, right? So each and everything is actually an unknown variable. It is statistically, it causes, it doesn't work. Similarly, trading also involves a number of unknown variables that act on the outcome of any particular behavior pattern a trader may identify and use as his edge. In trading, the unknown variables are all other traders who have the potential to come into market to put on or take off a trade. Okay. So each trader comes and just like how we have pressure applying when we play the game, each trader comes and they do a trade, right? So each trade is actually market contributing the market position at any given moment, which means that each trader acting on a belief about what is high and what is low contributes to the collective behavior pattern that is displayed at the moment. If there is a recognizable pattern and if the variables used to define that pattern conform to a particular trader's definition of an edge, then we can say that the market is offering the trader an opportunity to buy low and sell high based on the trader's definition. Okay. Suppose the trader seizes the opportunity to take advantage of this edge and puts on a trade. What factors will determine whether the market unfolds in the direction of his edge or against it? The answer is the behavior of other traders. So there is some pattern, say some triangle pattern or some symmetrical triangle or ascending triangle or descending triangle. Okay. And now we are looking at the pattern and we are seeing an opportunity and we are putting a trade. Now, what will happen if whether the trade which we take will win or not? So that is the how other people are behaving. What fact that is how that will decide whether your trade will win or not, irrespective of whether you have followed that pattern. If you even then there is an uncertainty at the moment he puts a trade on, and for as long as he chooses to stay in that trade, other traders will be participating in that market. They will be acting on their beliefs about what is high and what is low. At any given moment, some percentage of other traders will contribute to an outcome favorable to a trader's edge, and the participation of some percentage of traders will negate his edge. There is no way to know in advance how everyone else is going to behave and how their behavior will affect his trade. So the outcome of the trade is uncertain. The fact is, the outcome of every trade that anyone decides to make is affected in some way by the subsequent behavior of other traders participating in that market, making the outcome of all trades uncertain. Since all trades have an uncertain outcome, then like gambling, each trade has to be statistically independent of the next trade, the last trade, or any trades in the future, even though the trader may use the same set of known variables to identify his edge or each trade. So now the author is little bit, trying to tell that, you can have patterns and all these things, but still whether that pattern, whatever analysis you have done, whether it will succeed or not, it depends on the behavior of other traders. Okay. So because each and every person will be acting on his own belief, and some will contribute to the, for the which will benefit the trader who took the position. Some will actually go against his position. So sometimes if you are bullish, many others might also come and it will increase the price. Or sometimes some people will tell no, let's short it. So how everyone is going to behave and how their behavior will affect his trade and how the outcome will be, it is all uncertain. So the fact is, the outcome of every legal trade that anyone decides to make is affected in some way by the subsequent behavior of other traders participating in the market, right? So because of that, every trade which is each one of the stakes, and subsequent people how they behave, either the price might go up or go down, right? So as a result, the outcome is uncertain because what is going to happen in the future we won't know. Now since all the trades have an uncertain outcome, it is then like gambling, right? Then each trade has to be independent, statistically independent of the next trade and the last trade and any future. Even though the trader may use the same set of known variables to identify his edge for each trade. Furthermore, if the outcome of each individual trade is statistically independent of each other trade, there must also be a random distribution between wins and losses in any given string or set of trades, even though the odds of success for each individual trade may be in the trader's favor. Okay, so even though if the outcome of individual trade is statistically independent, right, then there must be random distribution between wins and losses in any given set of trades, even though the odds of success for each individual may be in the trader's favor. So even though if you might be thinking that whatever you have an edge and you have a pattern, it should definitely go something like that, but still what will happen, there is still an element of randomness. Okay. Third, casino owners don't try to predict or know in advance the outcome of each individual event. Aside from the fact that it would be extremely difficult given all the unknown variables operating in each game, it is not necessary to create consistent results. Casino operators have learned that all they have to do is keep the odds in their favor and have a large enough sample size of events so that their edges have ample opportunity to work. So what casino owners do that know that they know that every they need not create consistent results. Okay, it is basically they know all they do is they have to keep the odds in their favor and have a large enough sample size of events. Okay, so yeah, so this is what casino owners do, right? So we'll see how much. It's huge actually. Okay, we'll try to rate. So so far we have seen it's a little bit vague. Authors telling about you have some advantage and all these things, but each trade is having an uncertain outcome, and there is, even though you might have an edge, there is a you might sometimes win or lose. So there is some random distribution between the wins and losses, right? So you might take the same, you might expect it to win. You might think that this is a sure trade or something like that, but still it might lose. Okay, so and this is where the psychology of the casino owners come. What they do is they know that every game is going to be winning or losing. So what they do is they know that they have to keep the rules in their favor and have large number of people playing the game so that sometimes they will win, sometimes they will lose, but at the end they will make profit. Okay. Trading in the moment. So this is the probability concept. So this is where the author is trying to bring the concept of probability. So the author is trying to tell you don't have to keep winning every trade, but you have to take the trades which are probability where the edge of the probability is in your favor. Take those systems. Traders who have learned to think in probabilities approach the markets from virtually the same perspective. At the micro level, they believe that each trade or edge is unique. What they understand about nature of trading is that at any given moment, the market may look exactly the same on a chart as it did at previous moment, and the geometric measurements and mathematical calculations used to determine each edge can exactly be the same, can be exactly the same from one edge to the next, but the actual consistency of the market itself from one moment to next is never the same. Okay. So, so we have to think in terms of probabilities. Okay. So micro level, each trade is unique. Each candlestick is a unique candlestick. But from the nature of trading at any moment, the market may look exactly the same on a chart as it did in the previous moment, right? And everything, the pattern might be the same. Okay. But whether it will behave the consistently same market, it's the same way. No. So you might have double top pattern, you might have double bottom pattern, flag and pole pattern, all the patterns. But whether it will go in the up direction or down direction, whether it will be a breakout or breakdown, it will never be consistent, right? For any particular pattern to be exactly the same now as it was in some previous moment would require that every trader who participated in the previous moment be present, right? For that particular pattern to repeat, the same people who behave the same way, they should be there here, right? But it's not going to be possible, right? What's more, each of them would also have to interact with one another in exactly the same way over some period of time, right? Same whatever I said, to produce the exact same outcome to whatever pattern was being observed. The odds of that happening is non-existent. I mean, it can never happen, right? Unless you have a set of people who are decidedly who are there, small set of people who ask everybody to do the same thing, and you have decided in the beginning itself these people will win and these people will lose. The people who have lost, they have come there to trade to lose their money. Something like that only can happen. Otherwise, it won't happen, right? Or some operator driven. I don't know. It is extremely important that you understand this phenomenon because the psychological implications for your trading could not be more important. We can use all the various tools to analyze the market's behavior and find the patterns that represent the best edges. And from an analytical perspective, these patterns can appear to be precisely the same in every aspect, both mathematically and visually. But if the consistency of the group of traders who are creating the pattern now is different by even 1% from the group that created the pattern in the past, then the outcome of the current pattern has the potential to be different from the past pattern. Example of the analyst and chairman illustrates this point quite well. It takes only one trader somewhere in the world with a different belief about the future to change the outcome of any particular market pattern and negate the edge that pattern represents. So the author is asking us to understand this, right? If we can have whatever tools and whatever edge we have, but the kind of people who are trading now, group of traders who are trading at the time when we are trading, and the group of traders who are trading the previous pattern, they are not same, right? So somewhere some person might move that, push the bar to the other end. Okay. So the most fundamental characteristic of the market's behavior is that each now moment market situation, each now moment behavior pattern, and each now moment edge is always a unique occurrence with its own outcome and independent of all others. Uniqueness implies that anything can happen, either what we know or what we don't know. Okay. A constant flow of both known and unknown variables creates a probabilistic environment where we don't know for certain what will happen next. Okay. So yeah, so the most fundamental characteristic of the market's behavior is that each now moment market situation, each now moment behavior pattern, each now moment edge is always unique. So every time you go into a trade, it is actually unique. Okay. So anything can happen, and whatever we expect it to happen might happen or might not happen. And there is a flow of both known and unknown, right? And it seems logical. This last statement seems quite logical, even self-evident, but there is a huge problem here that is anything but logical or self-evident. Being aware of uncertainty and understanding the nature of probabilities does not equate with an ability to actually function effectively from a probabilistic perspective. Thinking in probabilities can be difficult to master because our minds don't naturally process information in this manner. Quite the contrary, our minds cause us to perceive what we know, and what we know is part of our past. Whereas in the market, every moment is new and unique, even though there may be similarities to something that occurred in the past. This means that unless we train our minds to perceive the uniqueness of each moment, that uniqueness will automatically be filtered out of our perception. We will perceive only what we know, minus any information that is blocked by our fears. Everything else will remain invisible. The bottom line is that there is some degree of sophistication to thinking in probabilities, which can take some people a considerable amount of effort to integrate into their mental systems as a functional thinking strategy. Most traders don't fully understand this. As a result, they mistakenly assume that they are thinking in probabilities because they have some degree of understanding of the concepts. So there is a probability, and the problem with the probability is that you cannot understand understand the nature of probability because we are not wired to think in terms of probability, and we always try to connect whatever we already know, and we tell that this is what will happen. But the beauty of market is that you can have your probabilities, you can have your edge, you can have your patterns, can have your indicators, all these things, but it is not guaranteed that that will happen. Okay, so we have to train our minds to perceive the uniqueness of each moment. Each moment is actually unique. So what will happen is, and we will perceive only what we know, minus any information that is blocked by our fears. Everything else will remain invisible. Okay, so what is happening is, if we don't train like that, then what actually we have to know what we have to perceive what we know, and we have to also remove our fears. Okay, so because what will happen, thus certain information we have to absorb, because those informations are not absorbed by us because we are scared. Okay, and only these two are needed, then everything else is invisible. The bottom line is that there is some degree of sophistication to thinking in probabilities, which can take some people a considerable amount of effort to integrate into their mental systems as a functional thinking strategy. Okay, so this way of thinking of probability is actually a little bit difficult. Okay, we don't know how to think in terms of probability, right? And we think that we are thinking in terms of probabilities, and because we have some understanding of the concepts. Okay, because we have learned some patterns, and we think that we know probabilities. Okay, so this is what the author is trying to tell, and he's still not yet said how to think in terms of probabilities. We'll see. I have worked with hundreds of traders who mistakenly assumed they thought in probabilities but did not. Here's an example of a trader I work with whom I call Bob. Bob is a certified trading advisor who manages approximately 50 million in investments. He has been in the business for almost 30 years. He came to one of my workshops because he was never able to produce more than 12 to 18% annual return on the accounts he managed. This was an adequate return, but Bob was extremely dissatisfied because his analytical abilities suggested that he should be achieving an annual return of 150 to 200%. I would describe Bob as being well versed in the nature of probabilities. In other words, he understood the concepts, but he did not function from a probabilistic perspective. Shortly after attending the workshop, he called to ask me for some advice. Here is the entry from my journal written immediately after that phone conversation. So Bob called. So the author has basically talking with a person called Bob, and he's a trading advisor, and he's getting returns of 12 to 18%, but he expected 150 to 200%. Okay, now This is where the problem is. Okay. So Bob called with a problem. He put on a belly trade and put his stop in the market.
Oh.
And the market traded about a third of the way to his stop and then went back to his entry point, where he decided to bail out of the trade. Almost immediately after he got out, the bellies went 500 points in the direction of this trade. But of course, he was out of the market. He did not realize what was going on. Okay. Uh, so this is a very common thing. So he put a trade and he put a stop loss, and the the trade went to almost one third of his stop loss. Okay, so you have some you enter at some 50, and you say you enter at some 100, and it goes and you have a stop loss at 50. From 100 it goes to some 80 or something, and then goes back to 100. At this point of time he went out, but after he went out from 100 it went to 500, okay, in his direction, but he was not there in the market, right? He did not understand what was going on. First I asked him what was at risk. He did not understand the equation question. He assumed that he had accepted the risk because he put in a stop. I responded that just because he put in a stop, it didn't mean that he had truly accepted the risk of the trade. There are many things that can be at risk: losing money, being wrong, not being perfect, etc., depending on one's underlying motivation for trading. I pointed out that a person's beliefs are always revealed by their actions. We can assume that he was operating out of a belief that to be a disciplined trader, one has to define the risk and put a stop in. And so he did. But a person can put in a stop and at the same time not believe that he is going to be stopped out or that the trade will ever work against him for that matter. So now it is like, he said that he thought putting a stop loss is the way to trade, because that is what disciplined traders do. But what he did was he was thinking that just because we put a stop and but we don't believe that our stop loss will get hit and the trade will go against him. So what happens is that belief was the problem, right? Uh, because why we don't accept that belief? Because he So why we don't accept that we our stop loss shouldn't get hit? Because why? Because we don't want to lose money. We don't want to be wrong, or we want to be perfect. Something like that. We cannot accept. We don't want to be not perfect, right? So because of these kind of things, this is the motivation. Okay, so this is where we enter either because of these kind of things. So, and because of these things we believe that our stop loss we will always win, but that's not the case. By the way he described the situation, it sounded to me as if this is exactly what happened to him. When he put on the trade, he did not believe he would be stopped out, nor did he believe the market would trade against him. In fact, he was so adamant about this that when the market came back to his entry point, he got out of the trade to punish the market with an "I'll show you" attitude for even going against him by one tick. Okay. After I pointed this out to him, he said this was exactly the attitude he had when he took off the trade. He said that he had been waiting for this particular trade for weeks, and when the market finally got to this point, he thought it would immediately reverse. I responded by reminding him to look at the experience as simply pointing the way to something that he needs to learn. A prerequisite for thinking in probabilities is that you accept the risk, because if you don't, you will not want to face the possibilities that you have not accepted if and when they do present themselves. So, so this is what thinking in probabilities is all about. Okay. So basically you accept that there is a probability your loss will hit, and if you don't, you will want, then what will happen is want to face that probability, and when that happens, we don't want to face it either. So this is the crux, and this is where all the position sizing and money management, I think, comes into picture, right? So even if you lose, at least you be at ease that this is money I'm ready to lose. When you have trained your mind to think in probabilities, it means you have fully accepted all the possibilities, and you always do something to take the unknown forces into the account. Okay. Thinking this way is virtually impossible unless you have done the mental work necessary to let go of the need to know what is going to happen next or the need to be right on each trade. In fact, the degree by which you think you know, assume you know, or in any way need to know what is going to happen next is equal to the degree to which you will fail as a trader. Okay. So unless we actually think, so this is what accepting the probability is basically, we have to do the mental work. Okay, what is the mental work? That the next trade is going to be, it can be anything can happen, so let go that this is what will happen, this is what should happen, like that. And the more you think in that way, the more you tell that this is what will happen, this is what will happen, this should happen, this, then the more we'll keep failing. Okay. Traders who have learned to think in probabilities are confident of their overall success because they commit themselves to taking every trade that conforms to their definition of an edge. They don't attempt to pick and choose the edges they think, assume, or believe are going to work and act on those, nor do they avoid the edges that, for whatever reason, they think, assume, or believe aren't going to work. Okay. So this is a little bit complicated line. So basically, the confident traders are the one because they have an edge. They believe in this probability. Okay. And they don't simply randomly pick whatever edges they think or assume or believe are going to work, nor do they avoid edges that whatever reason they think, assume are going to are not going to work. Okay. So they don't simply go by their assumptions. That is what the author is telling. If they did those things, they would be contradicting their belief that the now moment situation is always unique, creating a random distribution between wins and losses on any given string of edges. So what they do is they know that it is they don't go by random assumptions. And if they do go by random assumptions, what is happening now, that that is contradicting with the micro level. What is a micro level? That each trade, each candlestick is actually a unique way of behaving, right? So they know then, because if they simply randomly take, then it will be like it will be contradicting. So they have learned, usually quite painfully, that they don't know in advance which edges are going to work and which ones are not. They have stopped trying to predict the outcomes. They have found that by taking every edge, they correspondingly increase their sample size of trades, which in turn gives whatever edge they use ample opportunity to play itself out in their favor, just like the casinos. So what they do is they simply play each edge, and they simply follow the probability, and they know that if they simply keep playing with the probabilities, they will be able to win. That is what author is trying to tell. Okay. So we'll end up with this, I think. On the other hand, why do you think unsuccessful traders are obsessed with market analysis? They crave the sense of certainty that analysis appears to give them. Although few would admit it, the truth is that typical trader wants to be right on every single trade. He is desperately trying to create certainty where it just does not exist. The irony is that if he completely accepted the fact that certainty does not exist, he would create the certainty he craves. He would be absolutely certain that certainty does not exist. When you achieve complete acceptance of the uncertainty of each edge and the uniqueness of each moment, your frustration with the trading will end. Furthermore, you will no longer be susceptible to making all the typical trading errors that detract from your potential to be consistent and destroy your sense of confidence. For example, not defining the risk before getting into trade is by far the most common trading of all trading errors and starts the whole process of trading from an inappropriate perspective. In light of the fact that anything can happen, wouldn't it make perfect sense to decide before executing a trade what the market has to look, sound, or feel like to tell you your edge is not working? So, why doesn't the typical trader decide to do it or do it every single time? Okay, so here the author is trying to tell that unsuccessful traders are obsessed with market analysis. You can be expert in market analysis, technicals, and all these things, uh, but uh, but it doesn't work that way, right? So when you accept the uncertainty of each trade, okay, each then our frustration will end. We will not think too much about the outcome. Okay. Um, for example, one of the then if we accept the uncertainty, what will happen? Now you know that every trade, everything which we make is actually uncertain, right? So then we will actually know that it's uncertain, right? So if we know that it is uncertain, then what we will do, we'll start telling this is what we will lose. But what we are not doing, we want to be absolutely certain. Okay. So as a result, what we'll do, we will not define the risk. We will not tell what is the stop loss, how much I will lose in this trade, things like that, right? So this is what happens. We don't define the risk before, and why? Because we are so certain. Okay. In light of the fact that anything can happen, wouldn't it make perfect sense to decide before executing it what the market has to look, sound, or feel like to tell you your edge is not working? So why doesn't the typical trader decide to do it every single time? So why we don't do it? Because we know that uh, because we want to be right. We are so certain. We are not understanding that every trade is actually it can be a winner or loser, and because of that, it is mandatory that we have to put our risks. How much we have to know, how much we will lose, how much, and we should be okay with it. That is what this entire paragraph is all about. I have already given you the answer in the last chapter, but there is more to it, and there is also some tricky logic involved. But the answer is simple. A typical trader won't predefine the risk of getting into a trade because he doesn't believe it is necessary. The only way he could believe it isn't necessary is if he believes he knows what is going to happen next. The reason he believes he knows what is going to happen next is because he won't get into the trade until he is convinced that he is right. At the point where he is convinced the trader will be a winner, it is no longer necessary to define the risk because if he is right, there is no risk. So nicely written. So this is like very nicely written because there is a tricky logic which we put ourselves into our mind. What is the tricky logic? Because we don't simply go into some random trades. We know that this is a sure shot trade, and because of that, it's a sure shot trade. Why should I, uh, you know, I know it is a sure shot, and I won't take a trade until it is I'm right. So if I'm right, then why should I have a stop loss or something? Typical traders go through the exercise of convincing themselves that they are right before they get into a trade because the alternative is simply unacceptable. Okay. Our minds are wired to associate. As a result, being wrong on any given trade has the potential to be associated with other experience in a trader's life where he has been wrong. Okay. So the implication is that any trade can easily tap him into the accumulated pain of every time he has been wrong in his life. Okay. Given the huge backlog of unresolved negative energy surrounding what it means to be wrong that exists in most people, it is easy to see why each and every trade can literally take on the significance of life or death situation. So from our childhood, we have been, we have a huge backlog of unresolved energy where we have to be right. Okay. And so as a result, what happens is, you know, uh, each and every trade, we look at it as a life or death situation. Okay. So for the typical trader, determining what the market would have to look, sound, or feel like to tell him that a trade is not working would create an irreconcilable dilemma. On one hand, he desperately wants to win, and the only way he can do it is to participate. But the only way he will participate is if he's sure the trade will win. On the other hand, if he defines the risk, he's willfully gathering evidence that would negate something he has already convinced himself of. He will be contradicting the decision making process he went through to convince himself that the trade will work. Okay, so it's going still more deeper, right? And basically, what is there is a dilemma. What is the dilemma? We want to win, okay? And because we want to win, we will only take a trade only if we are convinced that we will win. But the other thing, what will happen is if we have to define the risk, then it means that we might lose. So it is like, we are desperate to win, but it is like, we might lose. Okay. So that is what is happening. So we have to convince ourselves that we might lose also. If he exposed himself to conflicting information, it would surely create some degree of doubt about the viability of the trade. If he allows himself to experience doubt, it is very unlikely he will participate. If he doesn't put the trade on and it turns out to be a winner, he will be in extremely agony. For some people, nothing hurts more than an opportunity recognized but missed because of self doubt. For the typical trader, the only way out of this psychological dilemma is to ignore the risk and remain convinced that the trade is right. Okay. So first we have to define, we will take a trade because we are there to win. But but we also have to define the risk. But we won't, if we define the risk, then it means that we will not win. Then there is a conflict which is happening. So what is happening now? We won't take the trade because we don't want to put the risk. Because if we put the risk, we know it we will not win. So we will not take the trade. But what is happening now? The market might go in our direction also. We might have won, but we didn't take the trade because of this. Now what is happening? We will be in so much pain because we had the opportunity, we didn't take it, but it gave us. So how to? So usually what we do, so we will ignore the risk, right? That is what this line is telling. Because if we accept the risk, we won't take the trade. And if we accept this, we don't take the trade. And if it goes in our direction, we lost the opportunity. That is also we might lose the opportunity. There's always, so that is what, so as a result, what we'll do, we'll ignore the risk, right? If any of this sound familiar, consider this. When you are convincing yourself that you are right, what you are saying to yourself is, I know who is in this market and who is about to come into the market. I know what they believe about what is high or what is low. Furthermore, I know each individual's capacity to act on those beliefs, the degree of clarity or relative lack of inner conflict with his knowledge. I am able to determine how the actions of each of these individuals will affect price movement in its collective form a second, a minute, an hour, a day, or a week from now. Looking at the process of convincing yourself that you are right from this perspective, it seems a bit absurd, doesn't it? So, the author is now telling that whenever you think you are right, okay, what actually we are saying is this is what we are saying. That is, I know what this market is, I know who is going to come, I know everybody, I know what they are going to do, I know this is a pattern, I know this is how they'll behave, I know everyone do every second, I know, right? So, but if you, when we tell that we are right, this is what is happening. For the traders who have learned to think in probabilities, there is no dilemma. Predefining the risk does not pose a problem for these traders because they don't trade from a right or wrong perspective. They have learned that trading doesn't have anything to do with being right or wrong on any individual trade. As a result, they don't perceive the risks of trading in the same way that a typical trader does. Okay. So yeah, if we think in terms of probabilities, then there is no dilemma. Okay. So what is the probability? It might win or lose, right? And because when you think in terms of probabilities, you are not going to trade in from a right or wrong perspective. See, here we are going to take a trade because we want to be right. As a result, what will happen? And if we have to be right, we will tell to ourselves that we are not wrong, going to be wrong, and only then we'll take a trade. Now, if you're not going wrong, why to put a stop loss? Why to have a loss, right? So if we are going to put a stop loss, then we might be wrong. So why to take the trade? This is the problem which will happen. So, but the when you think in terms of probability, you don't think from a right or wrong perspective. You basically do the trade from a probability perspective, and it might go right or it might go wrong. They have learned that trading does not have anything to do with being right or wrong on any individual trade. As a result, they don't perceive the risks of trading in the same way the typical trader does. Okay. So now trading doesn't have to be with right or wrong. What does that mean? If it is, if we perceive the risk in the normal trader works, they don't perceive it that way. How? They don't think that, risk is something if one means that we are losing. And if we are all going to win, why should we have a risk? Things like that. So they will simply think of it as a probability. Any of the best traders, the probability thinkers, could have just as much negative energy surrounding what it means to be wrong as the typical trader. But as long as they legitimately define trading as a probability game, their emotional responses to the outcome of any particular trade are equivalent to how the typical trader would feel about flipping a coin, calling heads, and seeing the coin come up tails. A wrong call, but for most people, being wrong about predicting the flip of a coin would not tap them into the accumulated pain of every other time in their lives they had been wrong. Okay. So what is this? What they are telling is that successful traders, what they do, they are probability thinkers. Okay. They might be surrounded by the negative energy. Okay. And, but when they think that, trading is a probability game, they actually, their emotional responses to the outcome to trade are equivalent to how the typical trader would feel about flipping a coin. Okay. So it's like, when you flip a coin, it you call head and it comes at tails. How will you behave? It's okay. You got tails. That is how the mindset of these probability thinkers would be. Okay. Uh, every time you toss a head and tail and you end up in tail, you don't end up in a emotional pain, right? So that is what these probability thinkers will be. Why? That is because most people know that the outcome of a coin toss is random. If you believe the outcome is random, then you naturally expect a random outcome. Randomness implies at least some degree of uncertainty. So when we believe in a random outcome, there is an implied acceptance that we don't know what that outcome will be. When we accept in advance of an event that we don't know how it will turn out, that acceptance has the effect of keeping our expectations neutral and open ended. Okay. Now we are getting down to the very core of what ails the typical trader. Any expectation about the market's behavior that is specific, well defined, or rigid instead of being neutral and open ended is unrealistic and potentially damaging. Okay. So this is what a typical trader he's getting down to the core. Okay. Just like how you toss a coin, it is random, there is some uncertainty. Okay. When we believe, we accept that we don't know what the outcome is. Okay. And when we accept in advance that we don't know how it will turn out, our expectations will be neutral and open-ended. So we will not have wild expectations, and because we know it is going to be random. Now we are getting down to the very core of what is the typical trader. Okay, any expectation about the market's behavior that is specific, well-defined, or rigid. Okay, instead of being neutral and open-ended, is unrealistic and potentially damaging. Okay, so this is what the expectation of market behavior. That is, if we think that it will be very specific, if it is very well defined, if it is going to be rigid, it is how it is going to behave, then what will happen? We will end up in damage. Okay, this is what the typical trader will do. What a typical trader? He will expect the market to be rigid and very well defined, but actually it is not. Okay, I define an unrealistic expectation as one that does not correspond with the possibilities available from the market's perspective. If each moment in the market is unique and anything is possible, then any expectation that does not reflect these boundaryless characteristics is unrealistic. Okay. So, what is the author is defining as unrealistic expectation? Okay, what is the unrealistic expectation? That does not correspond with the possibilities available from the market's perspective. If each moment is the market is unique, anything is possible, then any expectation that does not reflect these boundaryless characteristics is unrealistic. Okay, so you know that every situation, every behavior, every candlestick, every event in the market is random. Then how can we have unrealistic expectations? You cannot have. You cannot have unrealistic expectations that I will become a millionaire, I will become a billionaire, I will become rich, I'll become per day, I'll make 1 lakh. This is not going to happen. Why? Because each and every event in the market, every candlestick, every pattern, it is not guaranteed. It might win or it might lose. So don't have unrealistic expectations. So that is the end of this particular paragraph. We will continue about how to handle these expectations in the next chapter. Before we go, I'll just briefly tell what are all the things, how you have to think in terms of probabilities, and how there are two things in terms of probabilities. One is the micro level, where each and every trade is actually random. It has its own. It is not dependent on the previous trade. Just because one candle is red doesn't mean the next candle will be red. It can be red or green. At the same time, there are some patterns which we have studied, which will have some edge, but still, even that particular pattern, right, might fail. So that is what, so it is still a probability. Now, as a result, the author also says why it is then important that if it is a probability, then you have to handle your losses. Now, why we don't do the losses, why we don't take the losses, why we don't take the stop losses into account is because we don't accept this trading as a game of probabilities. And we want to be what is it called, right? We want to be always right. And if we accept, and we also want to win, and as a result, we don't want to accept that we are wrong. And if we are not wrong, why should put a stop loss? And if we are wrong, why we will never take the trade also? So this is the problem. Now, finally, the successful traders, they don't think in terms of every trade as right or wrong. They simply think in terms of probabilities. Just like how we toss a coin, and it can, if we tell head, but it might end up in tails. that that feeling which we get at that time, they will have the same feeling when they win or lose a trade. It is just a probability. And as a result, what they do, since they are thinking in terms of probabilities, they actually predefine the risk. This is what they will lose. And but the typical trader, what he does, he will expect the market as rigid, and as a result, he's very sure about how each it will behave, and as a result, he will have wild expectations. And the author is telling that those expectations are wild. Why? Because each and every moment in the market is unique. Each and every candlestick pattern is unique. It can go in the way we think, or it cannot go. So if it is so random, how can our expectations be so huge? Because we might fail. So with uh, this particular chapter, we'll end today's session. I hope this was useful. We will read about managing expectations tomorrow. If you guys have anything to tell, uh, please let me know. Else, we'll end this session. Okay. So thank you. Thanks a lot for participating in this reading session. Much appreciated. I'll upload this on the YouTube and then we'll continue this session tomorrow. Okay. Bye bye.